the shadow banking system is once again larger than the conventional banking system, they're not calling it quantitative easing, and they're taking great pains to not call it QE. A lot of the financing that has gone on in the shadows, but what's key is that the Fed does not regulate these entities.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or have not already done so, please do subscribe, click on the bell to be notified on new updates, and do give us a thumbs up if you like what we do. We really do appreciate your support, and we thank you for it. Our guest today is Danielle DiMartino Booth, CEO and Director of Intelligence for Quill Intelligence LLC, a research and analytics firm. Danielle spent 9 years at the Federal Reserve Bank of Dallas, where she served as advisor to President Richard W. Fisher until his retirement in March of 2015. Sounding an early warning about the housing bubble back in the 2000s, DiMartino Booth has earned a reputation for making bold predictions based on her detailed research. She is also the author of the Amazon bestseller, Fed Up, an insider's take on why the Federal Reserve is bad for America. And we are delighted to have her here again as our guest today. Good day, Danielle, and welcome back to SBTV. How are you doing?
I'm doing great today. How are you?
I'm doing fine. I know every day is a busy day for you, so we'll get started. Danielle, the Fed has been involved in emergency repos in the past few weeks now. But before we get into the Fed's recent actions, can you share with our viewers who may not be familiar with the topic, what is this repo market and how important is it in our financial system?
Well, think of the repo market the way you would the overnight lending rate. And the reason it should be thought of in that context is because the New York Fed is trying to move off of the LIBOR platform to something called SOFR, S-O-F-R. SOFR is going to be the preeminent overnight lending rate housed out of the New York Fed. What we hope to be, or what the New York Fed and what the Federal Reserve hopes to be, something that displaces LIBOR, even though there is a separate proxy for LIBOR coming up out of Europe. But the point is, SOFR, as it's called, is priced off of the overnight repo rate. You cannot have something that is critical to floating rate lending for the bulk of floating rate notes and bonds out there be attached to something that could potentially spike up to 8.5%, 10%. Yeah. The Federal Reserve has absolutely no choice but to get its arms around and stabilize the repo rate off of which SOFR is priced on a daily basis.
Okay. Now, in your book, Fed Up, it was mentioned, I believe, chapter 11 or 12, that Ben Bernanke was paying more attention to the Fed funds rate, not the shadow banking system. Can you first tell us if there is such a thing as a shadow banking system, and can you explain it to us who may not be familiar with this term?
Well, so you have to remember that I'm going to go back to LIBOR because that's the old world, right, that Ben Bernanke was not necessarily focused on. Shadow banking is actually a much broader term, and that applies to any off-balance sheet banking, of which we saw a ton of leading up to the years of the crisis. Many of the largest banks in America had warehouses, so to speak, warehouses of bonds, mortgages that were getting ready to be pooled into collateralized mortgage obligations. There were other off-balance sheet entities that were trying to make sure that their balance sheets didn't appear as big as they were, and then broaden the net out a little bit more. And then you get to prime brokerage, hedge funds, mutual funds, especially private equity in a post-crisis world. Private equity is sitting on $2.5 trillion of undeployed capital. What's key is this massive shadow banking system, which people have a very hard time getting their arms around. Call it, I'm using very bad numbers, but I'm trying to give you scope and scale. At least as it pertains to Ben Bernanke back in the day, The conventional banking system was $12 trillion. At the time that we were entering crisis, the shadow banking system was $17 trillion. Today, we know that the shadow banking system is once again larger than the conventional banking system, and that's in the aftermath of the global debt market growing from roughly 200 to nearly 250 trillion. A lot of the financing that has gone on in the shadows, but what's key is that the Fed does not regulate these entities.
How are the repos or repurchase agreements different from quantitative easing, where the Fed gives the bondholders cash in exchange for the bonds, or are they the same thing?
Well, they are the same thing in the sense that you've got to use the synonym for bonds and make it into bills. And this is something that the Federal Reserve's Lael Brainerd, she's on the Board of Governors, she's a permanent voting member. And this is something that she spelled out earlier on, and that was kind of targeting the lowest end of the maturity spectrum rates. That would be out to 1 year of maturity, as in Treasury bills. And that is exactly where the $60 billion per month of repo financing, but it really is quantitative easing, is aimed. They're not calling it quantitative easing, and they're taking great pains to not call it QE, simply because the crisis era QE as we knew it was specifically at the furthest end of the maturity by design. It was trying to get banks to take on risk and extend credit and ignite animal spirits. Right now, the Fed is telling you that they're staying in the maturities of less than 1 year in order to alleviate overnight funding strains in the market.
Since we're talking about a little bit about QE, if we can call it that, as a former Fed insider, do you recall how did the Fed conceive quantitative easing, given it was never done before?
Well, it was something that had certainly been thought of and carried out in Japan in the early 2000s, as Japan was trying to address its own getting to the zero bound of interest rates. So there was a blueprint at the time. In fact, Ben Bernanke made a very famous speech in which he said, if you truly want to achieve quantitative easing, then the country of Japan, should issue in perpetuity zero bonds. In other words, never have to be paid off and no coupon. In another world, that is actually called a fiat currency. But the suggestion was to issue these in perpetuity and have them have no coupon at all. You can check in your wallet. I think that's your dollar bill. But it was Ben Bernanke's original conception that was carried out in Japan and that he carried on over into the United States. In December of 2008, when the Fed went to the zero bound, Ben Bernanke very much had his eyes on easing strains in the credit market and forcing lenders to put money out into the economy. Unfortunately, they also started paying banks for interest on excess reserves, which achieves exactly the opposite effect, which we've learned in the aftermath of the crisis.
Okay. So in the week of September 16th, apparently a lot of cash flowed out of the repo market and securities flowed in, resulting in a sudden lack of cash to the financial institutions that needed it. And we saw overnight repo rates spike as high as almost 10% or so. How similar is this liquidity seizure or lockup, in a sense, similar to a run on, let's say, U.S. Treasuries, where bondholders trade in large amounts of securities and demand cash all at the same time? Would it have the same effect as what we witnessed in the recent weeks?
Well, it would be similar, but when you think of a run on a bank in the truest sense, because that's the word that run is typically associated with, then there is a crisis of collateral. And the reason that the liquidity crunch that led to the great financial crisis was of a different stripe, if you will, is because there was a complete collapse in the value or the perceived value of the collateral backing a lot of the instruments that banks were able to lend against in the past, such as mortgages, that future regulations precluded them from doing in the future. But by the way, that is at the crux of why there's been such a liquidity freeze, and that is because banks have been collateral constrained, if you will. There's been so little that banks have been able to use in order to access the overnight lending market. It has been shrunken down to the Treasury universe.
Okay. But how common are these liquidity seizure events? Can you recall when was the last time such an event happened, like what we're seeing right now?
No, in fact, you were looking down while I was expressing a look of utter shock because these are extremely rare events. The thing is, before the Fed's balance sheet was even $1 trillion, it was 868 some odd billion prior to the launch of the first quantitative easing. Prior to that, the Fed would regularly, as a course of business, inject liquidity into the financial system and take it out. And the Fed's balance sheet, as a regular course of business, grew at about 5% a year alongside the U.S. economy. So, but when there were liquidity strains, they were never as acute as they are because quantitative easing, to the scale that it was launched and the amount of repo and overnight lending and reserves and the size of the Fed's balance sheet, they were never of the size that they are today. So to see, it's not so much that liquidity freezes prior to the crisis weren't unusual. It was that they would have never registered on the radar screen versus $60 billion a month, which I would remind you is going to come out to 96% of the Treasury's net issuance over the course of the next 8 months. If the Fed was to decide to extend out this $60 billion a month to the 11th month, it will have grown its balance sheet by the equivalent of the quantitative tightening that it was able to undertake earlier on in shrinking its balance sheet. All of QT will be completely wiped away. So the unwind will be unwound.
With all these things going on, Danielle, do you think there's a deeper problem going on right now in the financial system?
Well, I mean, this is, of course, these are the questions I tend to get at around 1, 2 a.m. that when I'm going through my Twitter feed, I go right past. I'm like, whoa, they're up way too late at night asking these questions. They've got their tinfoil hat on. But the real challenge to Fed policymakers is that we have a collateralized loan obligation market. We have a leveraged loan market. We have a high yield bond market. And we even have the lowest rung of investment grade bonds that is over $3 trillion now. We have a corporate bond market in the United States that is more than doubled throughout this recovery. And what you don't want if you're Jay Powell is for an overnight lending situation wherein banks are charging each other too much and it spikes up to 8.5, 10. You don't want for banks to start digging deeper and trying to find the potential for credit questions. And that's the genie that remains in the bottle, though I would point out two different things. After the Powell pivot and after the Powell pirouette, which was in June, when Powell first alluded to the fact that the Fed was willing to use its balance sheet again, obviously several months later, they certainly have to a bigger extent than we ever thought possible. But in the aftermath of Powell's January pivot and his June pirouette, we have not seen CCC rated spreads come in the way that we have seen the stock market rebound, the way that we have seen the highest rated corporate bonds rebound in price, come down in yield, come down in spread. So there is a definite, and you can look at it on a graph, there is a definite amount of distrust in the market when it comes to the riskiest corporate debts out there. And we've seen an increase in Treasury volatility. It's the MOVE index. I follow it very closely, and it tends to precede a widening out in high yield spreads, which is exactly what landed us in the soup a year ago with the downgrade of General Electric's debt that ended up with a super freeze in the high yield market. This is what Jay Powell is trying to prevent, is any kind of contagion from the overnight lending market into this $10 trillion credit market, which I don't think he could address as easily as he is the repo situation.
Okay, we'll have to keep an eye on that one. But with the growing of the balance sheet once again and a return to lower interest rates, are you expecting a weaker dollar going forward?
Well, see, now that's the thing. Everything points to a global slowdown. And what had been isolated to Germany has now spread to France. We're seeing housing transactions in Spain down 21% year over year. We're seeing car sales in China down 15 out of the last 16 months. The reason I'm throwing these details out at you is as long as it remains a relative play, the dollar is going to maintain its strength. But as the evidence continues to build that the global economy is going into recession, anything that provides a hedge against it, i.e. gold and silver, will retain its value in the face of, and this is what people do not understand, you do not have to have inflation, and you do not have to have a weak dollar in order for gold and silver to outperform in times of financial market disruption.
It seems like we're heading back to zero. Any guesstimate on when we'll probably go to zero? And do you think we'll go into negative?
Well, I'm not convinced that Jay Powell actually wants to continue cutting interest rates. And I'm not so sure that this is the one thing that the markets have yet to clue into. We went into the week of the announcement that culminated with $60 billion a month with an 82% probability of a rate cut on October the 30th. We exited the week south of 60% in terms of rate cut probability for October 30th. And I think that this is exactly where Jay Powell wants to go. I think that he has dreams of a soft landing and 2 rate cuts and finished for his mid-cycle adjustment to become reality while he's got de facto QE that he won't call QE going on in the background that allows him to forestall even having the negative interest rate debate. I think Jay Powell wants to stop cutting interest rates.
Okay. But I mean, as if the rest of the world, I mean, the larger economies start heading into negative rates, is the U.S. going to have to follow, or can Jay Powell keep it above zero?
That's the multi-trillion-dollar question. I mean, you were asking the most critical question in the world right now, because we're trying to figure out if money printing that we don't call money printing can do the trick in weakening the dollar such that the competitive disadvantage at which our manufacturers find themselves sitting with doesn't disappear by virtue of only growing the Fed's balance sheet at the shortest maturities. Can Jay Powell thread that needle without having to follow the rest of the world into the abyss of negative interest rates? I think he wants to see that as an outcome, but there are a lot of different moving pieces and a lot that can go wrong.
I believe I heard you one time call negative interest rates un-American. Can you explain that?
Well, look, we have a fractional banking system in the United States. When I deposit $100 into, let's say, Jamie Dimon's vault, it's Jamie Dimon's obligation to only set aside what his reserve requirements require. After that reserve requirement is satisfied, he is required to lend out the balance of what I've deposited. Right. And then the next bank subsequent to takes that money, holds what it's required to hold in reserves, and lends out the balance. It's what greases the skids of the credit markets that keep the United States economy growing, albeit at an anemic rate. Now, if you all of a sudden say to Jamie Dimon, I'm going to charge you for that $100 deposit. I'm going to penalize you for that $100 deposit. Credit creation goes away, at least for your most credit-worthy customers. Your least credit-worthy customers, you're going to continue to charge them 17, 18% on their credit cards. Doesn't matter what the Federal Reserve does. But the impetus to keep the credit markets alive with negative interest rates in the United States, it dies. It goes away. So it is absolutely an un-American way of approaching monetary policy. And it also brings about all of these ideas that are socialist in nature that suggest that you cannot print money for the banks. You cannot bail out the banks. You're going to need to do QE for the people. That's the other thing that I think Jay Powell, who is a Republican, would like to avoid.
Fed, they try to hit their 2% inflation rate target. Danielle, is there any sort of empirical evidence at all that benefits this 2% inflation target?
No. I mean, this was the easiest question that you've asked me. mainly because it's the wrong target. They need to switch out something in the middle of the bullseye that actually reflects the healthcare costs of the average American, the true rental costs for the prices that housing has got up. None of these are reflected properly in the core PCE that the Fed leans on so much. The healthcare rates that they use to impute core PCE involve the Medicare and Medicare reimbursement rates. Those have nothing to do with reality. They have nothing to do with the fact that my healthcare premiums have gone up 18% over the last year. So, but the Fed's never going to hit a target if the target is, it's like cooking the books of the statistics. That's what the Fed does.
Despite the Fed trying its best to stay or hold off a coming recession, are you seeing signs of a recession or even a depression in the reality on the ground in terms of rising unemployment, slowing consumption, increasing dependence on welfare programs, etc.?
Well, look, what we are seeing is 10 consecutive months of slowdown in the freight industry. I bring up this small industry because we are a country that consumes. And if you've got big 18-wheelers hauling around less of you name it for 10 months running year over year, something is wrong. We've had increasing layoffs for 11 months running year over year. There's absolutely nothing to lead us to believe that the manufacturing industry in the United States is not in recession. And if you ask the people who are in the C-suites, the CEOs and the CFOs of services companies, which is 4 out of every 5 jobs in America, this came through in the most recent market services survey. Their employment index hit 50.4, with 50 being the dividing line between an expanding and a contracting economy, again, specific to services, and that's a 10-year low. So there is an abundance of evidence outside of the super interest rate sensitive housing market that has benefited from the 2 rate cuts that we've seen thus far. Outside of a rebound in housing, the car industry continues to weaken in the middle of a massive strike at General Motors, and everything we're seeing in terms of port activity, railroad activity, intermodal volumes, and again, back to freight, everything suggests to us that the U.S. economy is slowing of its own volition. And the Fed is trying to get out in front of this, and we'll see if it succeeds or not, because if it doesn't, the markets will price in very quickly further rate cuts. Okay.
Danielle, I know you touched on this, but what is your expectations for the outcome of the October FOMC meeting?
I truly think it's a coin toss at this point. In the September FOMC, they made it a point to put in the minutes something very unusual. I mean, highly unusual. That's saying a lot coming from me. And what they put in there was that several members of the committee would like for future statements to clarify that market pricing of rate cut probabilities is out of sync with the thinking on the committee. Now, can you imagine at 2:00 p.m. New York time on October the 30th, if the Federal Reserve's statement was to say, you know what, market, you've got it wrong. And then Jay Powell, 30 minutes later at 2:30 Eastern Standard, has to get up in front of the podium and all of the reporters and say, we didn't cut rates because you know what, market, you've got it wrong. The Fed has not defied market pricing for generations, plural now, since Greenspan was in office. So the odds of something like this occurring are low to me. But the fact that it came out in the minutes means that there are several hawkish members of the committee who would like to finally say the tail is no longer wagging the dog. We are in charge of setting interest rate policy, not the markets. So we'll see what happens.
Okay. Yes, we will. We'll see what happens. Danielle, before we wrap up, can you let our listeners know more about your work and Quill Intelligence LLC?
Yes, I'd be happy to. So Quill Intelligence it's a brand that's come about. We have our own hashtag Research Revolution, and we look every day with the publication of the Daily Feather to completely revamp the way you think of research and how it should be conceived and delivered. If you will, we're the anti-sell side. And we've also got a weekly quill that comes out, which is a deep dive I've been doing since I retired from the Fed. Once a week, every Wednesday, we publish more of an institutional product. But the Daily Feather is something that is easily accessible. It's dirt cheap. Go to quillintelligence.com. And if you're bored and you have insomnia and you promise not to send me tinfoil crazy questions in the middle of the night, follow me on Twitter at DiMartino Booth.
Okay, at DiMartino Booth, we got it. We got it, and we'll surely put up a link to your Quill Intelligence website. Are you writing another book soon?
I get asked that question all the time. And when the time came to make that decision, I chose to launch the Daily Feather instead of writing another book. I really do feel strongly that financial literacy on a daily basis is going to have to take precedence right now over me writing another book that still happens to be very timely because I'm still fed up and the book still resonates. Unfortunately, I thought Jay Powell was going to be the change agent that he has not turned out to be.
Yeah, well, let's still continue to have some hope in Jay. But exactly, your book is very timely. I think chapters 10, 11, 12, very timely for what's going on right now. But Danielle DiMartino Booth, we thank you for your time and coming on SBTV once again, and we wish you all the best.
Thank you so much. Appreciate your time.
That was Danielle DiMartino Booth of Quill Intelligence. For more of her insights on the Fed and the global economy, please read her book, Fed Up, an insider's take on why the Federal Reserve is bad for America, or visit her website, DiMartinoBooth.com. And if you'd like more SBTV, you can listen to us on podcasts at iTunes and Spotify.